Kindly note that the views and opinions shared in this video are those of the speaker and do not constitute advice given by Classic Private Wealth. Any advice given by Classic Private Wealth will be in writing in the form of a wealth management proposal. Classic Private Wealth is an authorized financial services provider.
Of individuals, weak balance sheets of businesses, and weak balance sheets of governments, and that will hold growth back for quite a long period, probably as many as 5. So, in fact, we think that it's fairly analogous to the recovery that happened after the Great Recession, the credit crunch, where we only saw the world economy go back to its previous levels of prosperity and markets back to their previous levels by about 2014 after the recession of 2008-09. So 4 or 5 slow years before we get back to normality. What I want to do now is just first of all to say for all of those that are joining us, we're now going to talk about the investment consequences and the what's new in the world for the next half an hour. So I want to actually go on to the investment consequences of the recession that we see. But before that, I just want to actually emphasize the very severe consequences of this. And just to give you an idea of how unprecedented the level of activity is, I want to go to the unemployment numbers that we've seen. So what we've seen, if we look at unemployment in the US is measured. So there are 2 measures. The one is new claims for unemployment insurance. Those new claims, having never exceeded in any specific week 500,000, has basically been above 2 million for every week since the start of the lockdown. And we've now seen roughly 30 million people start claiming unemployment insurance in the States. And in terms of the unemployment rate, we're seeing that the announced unemployment rate in April for the US, and that's measured roughly in the middle of April, so we know that things have gotten worse since then, sits at 16.1%, whereas in the recession of 1982, which brought on inflation under control, unemployment went to about 12%. In the credit crunch, it never went beyond 10%. So we're now seeing levels that we haven't seen since the Great Depression. So there's a massively high level of unemployment, and the longer this lasts, of course, the more damage it wreaks on balance sheets. But what it also says is that this is an upside down kind of incident. What normally happens is that recessions originate in the financial system. So something goes wrong in the credit markets or in the stock markets, and that spills over into the real economy. What happens in this case is that the problem started in the real economy, and markets are grappling to come to terms with that. So if we look at what happened to markets, you will see that markets initially, stock markets, there we can see the stock markets in the US. So you'll see 3 measures of the stock market: the NASDAQ, the S&P 500, and the Dow Jones. What you see there is that markets by late February, early March, when the markets realized what a state the economy is in and the very bad news about the economy, we had what was called a waterfall event. We had a very rapid drawdown in markets. In fact, it's the fastest that markets have lost more than 20% of their value ever. So a very rapid downdraft in markets, but the markets went down around 30%. So what you will see is the S&P 500, which is the widest measure of stock markets, went down by 30% from top to bottom. Whereas the NASDAQ, which is the tech-heavy part, only went down a little bit more than 20 because many of the components of the NASDAQ didn't really have so much trouble. And the Dow Jones, which is the most commonly used measure, but actually excludes many of the tech names, went down 35%. So markets around the world went down roughly 30 to 35%. And then what happened is that it became clear that the authorities will take very drastic action to try to support the economy. So there's been $3 trillion of relief measures from the US government. So not really stimulation measures, relief measures. But also the Federal Reserve has come to the party and has intervened very, very strongly in financial markets to the extent where it started buying corporate bonds, meaning if you are a large company in the US, you don't finance yourself through the bank, you finance yourself through issuing bonds. And although the bond market briefly dried up at the middle of March, you actually had the situation where as soon as they started buying corporate bonds, even corporate junk bonds, the general tenor in markets improved, and the perception was that this would be a V-shaped event, meaning, and you can see the V pretty much in the NASDAQ, you see it going down and then going back up. You don't quite see the V in the S&P 500 and the Dow Jones yet. So the Dow Jones still down about 15% and the S&P 500 about 10%. But our view of let's say, the muted reaction in this case of markets, because if you just compare this to previous events, in 2001, in the recession that followed 9/11 and the bursting of the dot-com bubble, the stock markets worldwide went down 50%, so significantly more than in this round. In the credit crunch, stock markets went down 60% around. So what we've seen in this case is about half the reaction of the credit crunch. And so why is it that the markets have reacted? The economy has shrunk far more than in any one of those two incidents, but the stock markets have not reacted as much. And maybe just a comment while we're talking about markets, there are two other markets where that has been very interesting. The one market that has lost a massive amount of value is the market for oil. So the commodity of oil has been something that has been very hard hit by this, because we produce in the world roughly 100 million barrels per day of oil, and we consume roughly 100 million barrels of oil in a normal situation. And what's happened in this crisis is that the consumption of oil has reduced by between 20 and 30 million barrels per day. So what that meant is the oil price went right down. So the oil price before this started was about $60 a barrel. We're now sitting at about $25 per barrel, and it went as low as zero. In fact, for a short period of time, 2 weeks or 3 weeks ago, you could actually trade oil. Oil actually traded at negative prices for a brief moment for some pretty esoteric reasons. So oil prices are a lot lower, and commodity prices are a lot lower than they were before, just because everybody realizes that there will be a lot less commodities and oil used during this period. So production is going ahead, but consumption has come to a virtual halt. At the same time, there's also been a devastation of emerging markets. So emerging market currencies have come under a great deal of pressure. So when markets came down so precipitously in March, you actually had a situation where you got into something of a liquidity crunch, meaning that there just wasn't enough dollars to go around. And what happens is that the Federal Reserve intervened in the US to provide as many dollars as people wanted. So that's part of why markets went back up. And secondly, it provided dollars to developed countries in order to ameliorate the dollar shortage. The pound briefly went to its lowest level since 1985, but it's recovered since. But emerging markets like South Africa, Turkey, Brazil, Indonesia, etc., have experienced very weak currencies. So in South Africa, we saw the rand go from about 14 rand to the dollar to about 19 rand to the dollar, so kind of losing about a third of its value. And that was not unusual. It's something that we actually saw happening all over the world. And what was associated with that is that you actually had a situation where the bonds of the governments of those countries actually lost a lot of value. So long-term interest rates in those developing countries also kicked up a lot and has stayed high. So if we look around the world, there are two prices we think is roughly realistic. The one is the oil price, and the other is the price in dollars of US government bonds, of developing country bonds, actually. So if you're looking at the bonds of the South African government issued in rands, it has lost in dollar value very close to 30%. So, and there's really no reason why it should stay low for much longer. So if we look at the rand, let's have a look at the picture of the rand, please. You can see that if you look at the rand, it is now way more than a standard deviation away. In fact, with the naked eye, we can see that it's roughly 2 standard deviations away from the average. So if you look at that graph comes from about 1994, and it shows you the rand in real terms, so with inflation taken out against the dollar. So we see that the rand currently is not as weak as it was in 2001, but it is roughly as weak as it was for the weekend that Des van Rooyen was the Minister of Finance in South Africa. So an event similar to the Des van Rooyen event, if you like. So the red line is the long run average. That little dotted line at the top is the one that says this is 1 standard deviation. So you see that we're about 2 standard deviations too weak. And then we have to ask ourselves, is it true that emerging countries will be far worse affected by this virus than developed countries? And there are some arguments that says that they will be slightly more affected because their governments are not in a position to intervene and support their economies to nearly the same extent that developed countries are. But in effect, what I would say is developing countries are actually going to come out of this on the other side of this much quicker. Even though it's a human tragedy, a lot more people will die and a lot more people will get ill, but developed countries will develop herd immunity and get out on the other side of this long before developed countries. So there's really no long-run reason to think that developing country exchange rates should be weaker on the other side of this. In fact, many developed countries, like South Africa, are exporters of commodities. And if the main remedy for the slowdown in the economy in the period 2021 to 2026 is infrastructure, then that's a commodity-intensive activity. So exports of developing countries like South Africa and Brazil are likely to do very well. So we're actually likely to see a recurrence of the strength of the rand that you see on this graph in 2004 to 2007, roughly. Very strong currency because of the kind of super cycle in commodities. So we actually think the opportunity in markets lies in the developing market bonds. We think those will appreciate in dollar terms very strongly over the next year or two, whereas we think that shares are still way overvalued. We don't think there's any rational explanation for share prices being as high as they are. We think that the actual economic trouble that we're in means that the stock market should actually go to somewhere between 50 and 60% below where they started, whereas what we're seeing at the moment is they are only 10 to 20% lower. So we think stock markets should go a lot lower than they are now. And we think that the reason for the stock market reaction being so unusual is the fact that the problem didn't originate in the financial system. The problem originated in the real economy. And at the same time, the Federal Reserve specifically has been very, very aggressive in providing liquidity. So the normal liquidity problems that accompanies a recession has not been seen. But we do think that as soon as markets realize that that this is not a V-shaped recovery, that the economy will be in a deep recession once we come out on the other side of the lockdown, and that recession will take multiple years to dissipate, we think stock markets will come to much lower levels. However, from an investment point of view, our choice is now actually much easier than it was about a month ago, because in the middle of April, stock markets were already down about 30%, and one could say, is that enough or not? And we thought, no, it's still not enough. But at this point, it's clear that markets, the balance of risk at this point is that if there is a V-shaped recovery and we quickly go back to where we were before, it's hard to think that stock markets should very quickly be much higher than they were before the problem started. So if we say that recovery will come quickly, we only have about 10 to 15% of further recovery in equity. So 10 to 15% upside in equities is not a lot, while we think that the downside in equities is at least 50%, the potential downside. So what is our strategy? Our strategy is to say we are staying clear of equity markets, but we are starting to nibble on other assets, things like emerging market bonds that we think offer very good value at this point. But we do think that there will be an opportunity towards the end of the year, most likely end of this year, early next year, when stock markets start to see the absolute devastation that this will wreak on the balance sheets of companies and on the profitability of companies, that stock markets will come down a lot more. So our basic idea is to say we will start participating again in stock markets in one of two events. The one is if the fall from top to bottom is somewhere between 50 and 60%, where we will just in terms of value say this is fantastic value, we want to get back. Or alternatively, where we want to go back into the stock market would be when we get to the point where we think that the extent of the recession is generally realized and that governments are putting enough stimulation into the economy to get out of that recession. Now, just to give you an indication, we believe that for the US, this means an additional $5 trillion of stimulation that will need to go into their economy over a multiple year period from 2021 to 2025 to get the US economy back on track. Just maybe a comment on what's happened to our clients in this. So our clients has had a good crisis, if you want to call it that, mainly for two reasons. The one is all of our clients had proper following distance, meaning they had enough cash, which was not affected by this incident, to tide themselves through the next 6 years. So they all knew that we can sit through this whole crisis until the full recovery has come without touching any of their long-term investments. At the same time, most of our clients' long-term money was invested in a strategy called dynamic parity. And if you look at the graph that we've got on there, you see that dynamic parity pretty much kept track with stock markets. The gray line is the global stock market. Pretty much kept track with the stock market, or a 60-40 balanced portfolio, which is the normal way that people invest long-term offshore. Pretty much kept track with that until the crisis came along. But when the crisis came, the dynamic parity strategy actually had a very small drawdown versus the large drawdown that we saw in in world stock markets. Now, dynamic parity, the interesting thing is that the reason why it didn't go down as much is twofold. It has a much more multi-asset approach. It's not as exposed to equities, first of all. But secondly, it also has something called speed changes, meaning that if volatility starts increasing, the system gives signals that market exposure should be reduced. And therefore, those signals arrived long before the market drawdown, and therefore the fund was mostly out of markets at the time that the drawdown came. What it did do, though, is it didn't actually put our clients back into the market for the uptick that came, basically because that uptick came with a lot of volatility. So all the volatility measures in the markets are still saying the markets are a very dangerous place at this point, and therefore dynamic parity has low exposure to various assets just because volatility is extremely high. And the strategy in dynamic parity is not to try to actually get in at the bottom. The strategy there is to wait until stability has returned to markets and then to participate in the longer term upside that we foresee. Now, again, the main thing that we have to explain at this point is why is it that stock markets are reacting so mildly to an event that in economic terms is so overwhelming, actually. And the main thing that you would see is that there's actually a very big difference between the comments that we're getting from economists and the comments that we're getting from market commentators. So most serious economists are saying that this is a devastating event. It's going to take a very long time for the economy to recover. We'll see very low interest rates for a long time, and we will also have to see a lot of stimulation coming into economies from governments in order to compensate for the amount of trouble that we see in the economy, the lack of demand. Now, again, if you talk about economists have a bit of a debate about is this event inflationary or deflationary. So most commentators looking at the market are saying governments around the world are printing lots of money, and that eventually is inflationary, so we need to protect ourselves on the other side of this against inflation. Most economists are actually saying there's massive destruction of demand through this, meaning the biggest problem we have on the other side of this is actually not a supply problem, although there will be some probably temporary, but some permanent reduction in productivity just because people will have disrupted supply chains, and it's also more difficult and more expensive if you have to produce while maintaining social distance, etc. So there'll be supply problems, but most of those will be temporary. But the demand problems will be long-lasting, meaning there just won't be enough people spending money. So the general consensus among economists is that this is a deflationary event, meaning this will put downward pressure on prices. And in fact, the challenge for governments everywhere will be to try to actually stabilize inflation at a positive level rather than at a negative level. And we know from the Japanese experience that once deflation takes hold, it's very difficult to overturn. So, in fact, the challenge for governments will be to put enough stimulation into the economy, not that they will trigger some form of inflation. So, the long and the short then for us is to say we like being in cash. We don't think it's a good time to turn your rands into dollars. Unless you hedge your rands back. So if you want to take part in global assets, but you are sitting on rands, you can turn your rands into dollars, but hedge back into rands and unhedge at a point where the rand is closer to a realistic value. And we think that realistic value is somewhere in the 15 to 16 rand level, at least, certainly not in the 18 to 19 rand area. But so we think that emerging market currencies like the rand is undervalued. We think that there's value to be had in South African government bonds. We think South African government bonds offer very large interest yields at this point, and will probably have some capital gains as well as long-term interest rates fall over the next year or two. But that may be a bit of a rough ride, because if there is another downdraft in shares, which we think is likely, that will again have negative liquidity effects worldwide. So there's fantastic value to be had, but maybe a little bit of a rough ride in the bond markets. We think there's also value in bonds globally. Turkish, Brazilian, Indonesian, maybe even Argentinian bonds may be attractive places to get fantastic yield. And then we think that there will be an opportunity at a later stage to turn dollar cash into shares at much more attractive prices than we see now, and that you would be able to take part not in a V-shaped recovery, but in a multi-year slow bull market, much more akin to what happened in 2009 to 2014 than to the rapid return to high prices that we saw between 1987 and 1988, for instance. So basically, that's my story. Maybe just some comment on what's happening at the moment. Right now, we're seeing a big debate around the world about what level of openness we can afford after having locked down quite severely. And I was interested, I saw last night, we had two economists giving comment to the CNN markets commentator, and he was asking them where on this trade-off between growth and lockdown and antivirus do you come down? And both of the economists were saying there is no trade-off. You have to bring in developed economies, you have to bring the level of infections down to a very low level and keep it there in order to get the economy to grow again. Otherwise, if you open up too soon, you'll just have a renewed epidemic, and then you'll have to close the economy right down again. So effectively, they're saying there is no trade-off. We think that in third world countries, there is a trade-off. You can have a stricter level of lockdown, and you can have fewer infections or a slower infection rate, but eventually you're going to have the full epidemic anyway in emerging economies. So to some extent, I guess there's also not a trade-off. But in emerging economies, there's a much stronger argument of saying poverty also kills. You've got to open up the economy more. We're going to have the infections anyway. Let's get on with opening our economy more. We can't maintain the very strict lockdowns, and there's no sense in maintaining the strict lockdowns. But in developed economies, it's clear that the best economic measure would be to get your infections to a very low level and then maintain that very low level through tracking and tracing and massive testing. So one of the suggestions there's been in America is that they should get themselves to a level where they can test every American every day. Because then effectively you can open your whole economy and you can only deal with the people that are infected. Remove the infected people from the general community, but basically test everybody every day, and anyone who tests positive gets isolated. That would work, but we're not close to the level of testing that would enable that. But so that's a kind of radical idea of saying we can open up the economy, we just need to test enough. But what we are seeing is that in many of those developed economies, we are now seeing them opening up much sooner than the medical experts want and that even economists want. So we are likely to see at least partial recurrences of epidemics in some developed countries, which will force those countries back into strict lockdown. So we are likely to see at least another 6 months of the 90% economy in most places in the world, a massive epidemic in most developing countries in the world, and intermittent epidemics in developed countries, which will keep the economy at a fairly low rate of activity, which will continue to devastate the balance sheets of all the participants in the economy. And the conclusion for us as investors is that, first of all, we think that shares are too high. We don't think there's much sense in participating at this point in shares because we think the upside is limited. But we do still think that this whole epidemic will give us a fantastic opportunity to buy shares at much lower levels than we are seeing now, somewhere around the end of the year.